Welcome back to the Commodities Trade Institute podcast, your daily breakdown of the global commodities markets and the forces moving them. I'm your host, Emily Costa. Today is Friday, May 8th, 2026, and we're looking at a market landscape defined by shadows. Shadow fleets in the Persian Gulf, shadow trading in the oil pits, and the sudden physical emergence of a long-dormant nuclear fuel market. We start today in the metals space, where the Chicago Mercantile Exchange is making a move that could fundamentally change how the world prices the future of energy. For years, the uranium market has been something of a closed club, thinly traded, opaque, and largely financially settled. But sources are now confirming that the CME Group plans to launch a physically based uranium futures contract. This is a massive structural shift. We're seeing a surge in investor interest driven by two primary engines: the global push to meet climate targets and the insatiable power hunger of massive data centers. Right now, the existing contracts are barely moving, with very little open interest. By introducing physical delivery via facilities like Converdyn, the CME is essentially inviting institutional big money to treat yellow cake like copper or crude. It's a sign that the nuclear renaissance is no longer just a talking point, it's becoming a liquid asset class. Staying with metals but moving to the battery sector, a significant regional alliance is forming in Southeast Asia. The nickel associations of Indonesia and the Philippines have signed a memorandum of understanding to cooperate on downstream processing. This isn't just a diplomatic handshake. Indonesia is already a powerhouse, exporting nearly $10 billion in nickel products last year. But they need specific mineral ratios to keep their stainless steel and battery plants running efficiently. By integrating the Philippines into this value chain, we're seeing the birth of a regional supply hub that aims to move beyond just shipping raw ore to becoming a high-value manufacturing center. In the world of agriculture, the focus is squarely on the upcoming summit between President Trump and Chinese leader Xi Jinping. American beef producers are desperate to get back into the Chinese market. It is a stark situation. More than 400 United States beef plants, roughly 65% of those previously registered, have lost their eligibility to export to China because Beijing simply let their licenses expire. This has happened despite the Phase 1 trade agreement. While United States cattle supplies are tight and prices are at record highs, producers are hoping this mid-May summit provides the political gesture needed to reopen the gates. However, the internal math in China is changing. They are pushing for domestic high-end cattle production and have introduced new quotas and tariffs that make American meat less competitive than Australian imports. Looking further south, the harvest outlook in Brazil is softening. Agribusiness consultancy AgroConsult is forecasting a 7% year-on-year drop for the 2025 to 2026 corn crop, bringing it down to 140.5 million metric tons. The culprit is a combination of late planting and erratic rainfall. This tightening supply in South America is mirrored by a slowdown in Russian wheat exports. Even though Russia remains the world's top exporter, a strengthening ruble is making their grain less profitable on the international stage, leading analysts to trim their export forecasts to around 44.5 million tons. Turning to dry freight and logistics, the tariff front-running we saw last year in the copper market seems to be hitting a wall. In 2025, the United States sucked in a record 1.64 million tons of refined copper, as traders bet on looming tariffs. While refined copper eventually got an exemption, the result is a domestic market currently sitting on a mountain of inventory, over 500,000 tons in the first quarter alone. But don't expect another record year. Logistics costs are exploding. Because of the ongoing conflict in the Middle East, war risk premiums for shipping have shot up 40 to 60 times in just a matter of weeks. Between those freight costs and the fact that United States warehouses are nearly half full, the massive risk-free opportunity to move copper into the States is evaporating. In the energy sector, the Australian government has just announced what many are calling a historic structural shift. They are mandating that energy exporters reserve 20% of their natural gas for the domestic market on the East Coast, Australia is one of the largest liquefied natural gas exporters in the world, yet its citizens are facing soaring energy bills. This policy is a direct attempt to disconnect Australian domestic prices from the volatile international spikes we've seen since the Iran war began. While manufacturers are cheering the move for the sake of energy security, investors are wary. We saw shares in major players like Santos and Origin Energy take a hit on the news, as this adds a new layer of regulatory risk to future projects. This domestic policy shift comes at a time when the global gas outlook is increasingly grim. The International Energy Agency reports that the conflict in the Middle East has already wiped out approximately 120 billion cubic meters of global liquefied natural gas supply through 2030. Iranian attacks have specifically knocked out 17% of Qatar's export capacity. This is creating a massive headache for Europe, where storage levels are currently 30% below the 5-year average. As we head into the summer cooling season, the race to fill those tanks to 90% capacity is going to require an extra 10 billion cubic meters of gas that simply might not be there. Finally, we have to talk about the bombshell reporting surrounding the oil markets. We are now seeing evidence of what can only be described as a staggering $7 billion in well-timed bets against oil prices just before major announcements regarding the Iran war. Between March and April, traders placed massive short positions minutes before President Trump announced ceasefires or delays in attacks. On April 7th, for instance, over $2 billion in sell orders hit the market during a period when trading volumes are usually paper-thin. Minutes later, a 2-week ceasefire was announced and prices plunged 15%. The Department of Justice and the Commodity Futures Trading Commission are under immense pressure to figure out if this was just incredible market intuition or a massive leak of non-public information. While the paper markets are under scrutiny, the physical movement of oil in the Gulf is becoming a game of cat and mouse. The United Arab Emirates has begun using dark tankers, vessels with their location transponders turned off, to slip crude through the Strait of Hormuz. With the strait effectively closed to everyone except Iran, the Emirates are taking massive risks to move oil that has been bottled up by the conflict. We've seen at least 6 million barrels of their Upper Zakum and Das grades move through this ghost fleet system in April, often using ship-to-ship transfers in open water to hide the origin and destination of the cargo. One of these cargoes reportedly sold at a record $20 premium over official prices. It's a high-stakes gamble. Just this week, an empty tanker was targeted by drone strikes. The theme across every sector today is the same. The old rules of transparent, open trade are being rewritten by geopolitical necessity and, in some cases, opportunism. Whether it's the physicalization of uranium or the dark shipping of Gulf crude, the markets are finding ways to adapt to a world at war. If you found this episode valuable, be sure to subscribe, share, and leave a review. Find us online at commoditiesinstitute.com.